By every traditional rule of investing, 2025 should have been a celebration year for big tech. Revenues surged, profits hit record highs. AI went from promise to product, from demo to deployment. And yet, if you just glanced at the stock charts, you'd be forgiven for thinking nothing much happened at all. This is the strange tension at the heart of today's market. The most powerful companies on earth are printing money, reshaping industries, and pouring hundreds of billions into the infrastructure of the future. Yet their share prices look bored, not broken, not collapsing, just unimpressed. That disconnect is what makes this moment fascinating, because beneath the surface calm sits one of the most aggressive capital expansions in modern corporate history. Data centers rising out of deserts, power grids quietly re-engineered, chips sold out years in advance, CEOs speaking less about experiments and more about inevitability. Artificial intelligence isn't a side project anymore. It's the backbone of future growth, and no group embodies that shift more than the so-called Magnificent Seven. These 7 companies now dominate the index, dominate earnings growth, and dominate AI spending. They are bigger, richer, and more strategically entrenched than any cohort of firms before them. If AI truly reshapes the economy, logic says they should be unstoppable. And yet, investors hesitated. In 2025, markets did something unusual. They stopped rewarding greatness automatically. They asked harder questions. They looked past earnings beats and into cash flow statements. They questioned whether today's growth was borrowing too much from tomorrow. And they quietly punished any hint of inefficiency, even from companies once treated as untouchable. That's why 2025 mattered. Not because AI disappointed, it didn't. Not because earnings slowed, they didn't. But because 2025 revealed the new rules of the game. It showed us what happens when expectations reach escape velocity, when capital spending becomes both a competitive advantage and a risk, and when even the best businesses in the world are forced to prove quarter after quarter that scale still translates into shareholder returns. This video isn't about whether AI is real. That debate is over. It's about what the market learned in 2025 and what that lesson means for the next decade of mega cap tech, valuations, and returns. Because sometimes the most important market signal isn't excitement or fear, it's indifference. 2025 felt like a paradox year for markets. Earnings surged, guidance stayed upbeat, yet share prices mostly treaded water. Nowhere was this more visible than in the so-called Magnificent Seven. Apple, Microsoft, Alphabet, owner of Google, Amazon, Meta, nvidia, and Tesla. Together, they still make up roughly 30% of the S&P 500, meaning even modest moves ripple through the entire index. These companies dominate because they sit at the intersection of scale, data, distribution, and capital, 4 advantages that compound over time and are brutally hard to replicate. But by early 2025, investors were nursing an AI hangover. The explosive re-rating of 2023-2024 left valuations stretched and expectations sky high. Earnings could grow 20 to 40% and still feel not enough. One portfolio manager joked on a February earnings call that the market was acting like a restaurant critic, impressed by the cooking but deducting points because the hype was too loud. So 2025 opened with a strange tone. AI was everywhere, in earnings decks, conference calls, and capital budgets, yet stock charts looked sleepy. The stage was set for a year where fundamentals screamed strength, but prices whispered doubt. However, on paper, 2025 should have been a victory lap. Nvidia once again beat revenue expectations by billions. Microsoft posted double-digit cloud growth driven by AI workloads, and Meta delivered its highest operating margin since before the metaverse pivot. Consensus earnings for the Magnificent Seven rose steadily through the year, yet the stocks mostly failed to keep pace with the broader S&P 500. By mid-year, more than half of the group had underperformed the index despite beating earnings estimates multiple quarters in a row. Apple's services growth impressed, but the stock stalled. Alphabet's AI-powered search updates boosted engagement, but shares barely reacted. This disconnect frustrated executives. One CFO privately remarked at an investor conference that it felt like acing the exam and still getting a B-. Markets weren't ignoring earnings, they were discounting them. The sense was that these results were already priced in, or worse, that peak growth was being borrowed from the future. The result was a market that applauded politely, then checked its watch. If earnings were strong, spending was even louder. By 2025, the AI arms race had crossed a psychological threshold. Over $400 billion in combined capital expenditure commitments tied to data centers, chips, networking, and power infrastructure. Microsoft and Alphabet expanded hyperscaler campuses across the US and Europe. Amazon quietly accelerated AWS build-outs after a slow 2024. Meta surprised skeptics by doubling down, framing AI infrastructure as its next social graph. Nvidia sat at the center of it all, shipping GPUs as fast as factories could produce them. One supplier joked that their biggest operational risk wasn't demand, it was forklifts. Most of this spending traced back to the Magnificent Seven, whose balance sheets allowed them to fund projects that would cripple smaller rivals. A telling anecdote came from a Texas utility executive who said AI data center demand had reshaped 5-year power forecasts in under 6 months. That's how fast this race moved. AI wasn't just software anymore, it was concrete, copper, and kilowatts. And while investors admired the ambition, they also began to ask a quieter question. Who exactly would earn the return on all this steel and silicon? As the year wore on, the tension became clearer. Earnings were rising, but free cash flow wasn't always keeping pace. Depreciation schedules lengthened, capex ballooned, and margins came under pressure, especially for cloud-heavy businesses. Microsoft's operating income grew, but free cash flow margins dipped as AI infrastructure costs surged. Google saw similar dynamics, with capital intensity reaching levels last seen during its early data center expansion years. Investors started to flinch. One analyst described it as the difference between AI as a story and AI as a line item. The fantasy was frictionless growth. The reality involved power contracts, maintenance, and replacement cycles. Even Meta, lauded for its cost-disciplined comeback, warned that AI spending would rise meaningfully before monetization fully materialized. This didn't mean AI was unprofitable, far from it, but it did mean the payoff curve was longer and lumpier than many had assumed. Markets that had got used to clean, high-margin software economics had to relearn what heavy investment phases look like. Free cash flow, not earnings per share beats, became the new credibility test, and some investors weren't yet convinced. Part of the Magnificent Seven malaise came down to uneven performance inside the group. Nvidia and Meta looked every bit the AI era winners, with accelerating revenue and clear demand signals. Microsoft remained steady, its diversified model cushioning heavy AI spend. But Apple and Tesla told a different story. Apple struggled with slower hardware cycles and uneven AI messaging, prompting concerns that it was playing defense rather than offense. Tesla faced margin compression, price wars, and growing skepticism around its AI narrative beyond autonomy promises. Together, these two giants weighed heavily on the basket's perception. This distortion mattered. When investors talked about the Magnificent Seven underperforming, they often meant 2 or 3 names dragging the average down. A hedge fund manager quipped that it felt more like the Fantastic Four plus roommates. The divergence created confusion. Was this a broad tech slowdown or a stock-specific reckoning? By late 2025, it was clear the story wasn't uniform dominance, but selective execution, and markets were getting more comfortable discriminating rather than buying the group as a monolith. By the second half of 2025, a new idea crept into earnings calls and analyst notes. What if AI capex was near a short-term peak, not collapsing, but plateauing? Several companies hinted that the frantic build-out phase might give way to optimization. Utilization rates mattered more than square footage. Efficiency, not scale, became the buzzword. Amazon spoke about sweating existing assets harder. Google highlighted custom silicon as a way to moderate spending growth. Even Nvidia acknowledged that customers were shifting from acquire everything to deploy intelligently. The implication wasn't bearish, but it was sobering. A slowdown in capex growth would ripple through the ecosystem. Hardware suppliers would feel it first. Cloud growth might look less explosive, but more sustainable. For investors, it raised a key question. Had 2025 pulled forward too much future growth? If capex did peak, margins could eventually recover, but top-line growth might normalize. The market's muted reaction suggested investors were already gaming this scenario out, even as headlines still screamed AI boom. Valuation was the quiet anchor holding stocks down. Even after a year of sideways trading, many Magnificent Seven names still traded at premiums to their own history, justified by growth, but vulnerable to disappointment. Higher interest rates raised the discount rate on future cash flows, making long-dated AI payoffs less seductive. Macro jitters didn't help. Sticky inflation, election uncertainty, and geopolitical risk made investors less willing to pay for perfection. One strategist summed it up neatly: these are incredible businesses, but they're priced like nothing can go wrong. So, When earnings came in merely great instead of astonishing, stocks shrugged. The market wasn't bearish, it was demanding. Valuations had turned earnings season into a pass-fail exam with no extra credit. This created the odd spectacle of world-class results meeting indifferent price action. It wasn't disbelief, it was discipline, and it suggested that the era of effortless multiple expansion for mega cap tech might be behind us, at least for now. Stepping back, 2025 felt less like a verdict on AI and more like a reset of expectations. The earnings proved that the Magnificent Seven still possess extraordinary competitive advantages. Their scale, data, and capital access remain unmatched. AI is real, monetizable, and transformative. But the year also hinted at a more mature phase ahead. Growth may remain strong, yet returns could be lower or more uneven. Investors will have to work harder, differentiate more, and accept that even dominant companies cycle through heavy investment periods. In that sense, 2025 didn't signal the end of mega cap tech dominance. It signaled its normalization. These firms are becoming infrastructure, not moonshots. That's still powerful, just less intoxicating. For the next decade, the question won't be whether they win, but how efficiently they will win. The market has stopped applauding ambition alone. It wants proof, patience, and eventually cash. Thanks for watching. If you enjoy hearing about stories in tech and you want to support the channel, the best thing you can do is to like and subscribe. See you for the next one.